The Zimbabwean government plans to list bonds issued to former farmers on international stock exchanges, and any payment made to compensate for farm improvements will not be taxed, as it sweetens the offer after failing to meet its obligations. Zimbabwe was to pay $1.75 billion as compensation to former farm owners by July 29th, according to the global compensation deed signed 2 years ago. And 2 years ago, the country tabled a $3.5 billion offer to the former farmers as compensation for assets expropriated during the fast-track land reform exercise. Of that amount, the $1.75 billion was supposed to be paid in July this year, while the balance would be paid in installments of $437.5 million per year for the next 4 years. But this has not happened, and now the government wants to try something else. Joining me from Harare, Zimbabwe, is Dr. Prosper Chitambara. He's a development economist and policy advisor. Prosper, welcome back to the show again. Thank you so much for joining me.
Thank you so much for having me.
When we look at the global compensation deed that was signed 2 years ago, Zimbabwe tabling a $3.5 billion offer, we know that this thing is a decades-old problem and that the country has struggled to meet its obligations and meet up with the agreements made by both the country and even with Western partners. So let's start from there. Why has it been so difficult for Zimbabwe to pay the compensation it has agreed to pay?
Well, I think it's because of a number of reasons. First and foremost, the economy has not been doing well. The economy has not been growing sustainably. So that's a major challenge. Number two, the economy is heavily indebted. Our total debt stock is estimated at, I know the government figures are a bit conservative. They are saying $18.2 billion US dollars, but the International Monetary Fund has estimated our total debt stock, the external debt stock rather, at about 18 billion US dollars. And out 70% of that total debt stock are actually arrears. So it means we've not been able to service our debts. So we've been attracting penalties and charges because of our inability to pay our debts. But I would say our biggest problem is the low and inadequate economic growth. For most years, our economy has been in decline. Our economy has been a victim of climate change. Our economy has been affected by the challenges that happened, obviously, in the agricultural sector following the land reform program in the early 2000s. So we haven't really been able to grow the economy in a sustainable way. And for me, that's one of the best ways of dealing with the problem of debt, is to ensure that the economy is generating enough growth, which is actually more than the interest rate that you're actually paying upon your debt. So that's been a major problem in the case of Zimbabwe.
Prosper, we're going to take a quick break. When we come back, we'll pick up this situation and now get into what the new offer from Zimbabwe's government is. So stick around, the conversation will continue after this. My guest is still Dr. Prosper Chitambara, joining me from Harare, Zimbabwe. As we look at the new deal, the government is offering former farmers in what has become a decades-old problem for the country. So, Prosper, let's look at this. You've explained why it might be quite difficult for Zimbabwe to pay these obligations, and a lot of people will sort of link it back to the sanctions that came about because of it, that even the sanctions are making it difficult for Zimbabwe to fulfill its obligations. But beyond that, now the country is offering to pay using 20-year bonds. Former farmers have been told that they will list the bonds on the international stock exchanges, and that would create a certainty that the government is committed and to give them the ability to sell in the future. So do we have any more details as to how these bonds would work?
No, I think there's been a bit of information asymmetry, opacity with respect to the details of this planned 20-year bond. The Minister of Finance hasn't yet given us more details, or even probably reported to Parliament on the details and the terms surrounding this proposed 20-year bond.
So is this really the best time? We're also in a situation where the global economy is not at the best. The bond markets, the issues with African economies going to the bond markets is there as well. And many have pointed out that there's a hawkish interest rates now. So is this really the time for Zimbabwe to be offering this bond as a way to sort the compensation? And if that's not the option, what other option does Zimbabwe have to sort this issue?
No, I think I agree that the timing may be a bit tricky, given what you've already mentioned, and obviously given the fact that there's a high country risk premium that is actually attached to Zimbabwe. So obviously the interest rates would be on the very, very high side, given the high risk profile that is associated with lending or doing business with Zimbabwe. But in terms of whether we have many options, I think that's our biggest challenge, is that the government doesn't actually have many degrees of freedom in terms of other ways and means of actually financing this $3.5 billion compensation package. Of course, we know, or so far, government has been able to pay just a token amount of US $1 million. But government is very limited in terms of its fiscal capacity, or even if its financial capacity to be able to pay a significant amount of the package, the total package.
So that brings me back to what I sort of alluded to before. The sanctions were placed on Zimbabwe, particularly by the U.S., because of this land reform situation from the 1990s. The same sanctions have made it almost impossible for the economy to grow, for the economy to also be to a place where the country can compensate the farmers. So now I have to ask, in terms of the former farmers, what's their reception of this new deal from Zimbabwe? And have we heard from the U.S. now as to what the U.S. is saying? Is this a way or a direction that the U.S. will support Zimbabwe in order to pay the compensation?
I missed an earlier part of the question, but according to what we know, as part of the ZIDERA Act, I think the compensation of the former white farmers is one of the key conditions that the government of Zimbabwe must fulfill in order for the sanctions to be actually lifted. But of course, there are other conditions that are also mentioned in terms of freeing up, say, the public media space and a number of other measures. But the issue of the compensation of the former white farmers is I would say, is the biggest condition. And if we're able to clear that, definitely that will go a long way in terms of our re-engagement with the international community, our re-engagement with the West. And that will probably normalize our relations.
Okay, so the last part of the question is, has the U.S. responded to this new deal that Zimbabwe has put on the table for the farmers?
No, we haven't seen any response from the U.S. government. Okay. But I'm sure they are obviously following up developments to check on progress, like other interested partners.
And I still come back to this issue of sanctions, Prosper. So this land redistribution was part of the land reforms that the government started in the 1980s. And that was to address issues that even came up before independence. These are long-standing issues for many African countries, but particularly for Zimbabwe, we saw that. And there have been serious consequences. We saw the collapse of Zimbabwe's economy in the 2000s, and even the sanctions and the struggle Zimbabwe has had over the decades now to find sure footing. What other impacts has the decision of land redistribution had on Zimbabwe?
Yeah, so we have seen over the past years a massive decline in agricultural productivity, yields in general. And of course, even agricultural output is also gone down. Remember, Zimbabwe used to be one of the biggest exporters of food, not just within Southern Africa, but also even on the African continent. But currently, Zimbabwe is a net food importer. So, and the issues of financing of agriculture, they've also been problematic. And of course, we've seen government bearing a disproportionate brunt or burden in terms of the financing of agriculture. The issue of title to land, that has also been an issue, which in my view must be quickly sorted out in order to allow the private sector to be able to come on board in a bigger way. So I think we need to see the private sector more and more involved in terms of the financing of the agricultural sector. But then obviously the issue of infrastructure, rural infrastructure in general, as well as irrigation infrastructure. I think we need to enhance that. Currently, only about 15% of potentially irrigable land is under irrigation. So I think we need to put in place irrigation so as to climate-proof our agricultural sector.
So overall, Prosper, do you think that this new deal or this new direction that Zimbabwe wants to take is a good one and can help finally put this issue to bed?
You mean the issuance of the bond?
Of the compensation.
Oh, yeah. In general, I think compensation, that's the right way to do things. I believe that the former white farmers must be compensated for the improvements that they've done on the land. And like I said, it's critical in order to for re-engagement rather of Zimbabwe in the international community. I think without the compensation, then it will be difficult for Zimbabwe to normalize its relations, whether it's political or even economic and financial relations with the international community.
All right, Dr. Prosper Chitambara, thank you so much for your time. We'll be watching this, and hopefully with some reactions from the West, we'll know that Zimbabwe is on track to settle this issue once and for all. Thank you so much.
Thank you so much.
And throughout the years, there have been lawsuits and sanctions, all tied to the land reform program of Zimbabwe. And after close to 2 decades, the country started the process of returning land to farmers whose farms were taken over. The United States continues to demand that the country must return the land before it can lift sanctions it has imposed on the once flourishing Southern African country. It's a conversation we'll continue to follow. You're watching Business Edge. We'll be getting into Stock Market Watch in just a bit. Just stick around. The all-share index of the Nigerian Stock Exchange is up 15.4% year to date. This indicates that investors in the bourse are optimistic about the futures of listed Nigerian companies. The oil and gas index, which features a collection of the biggest firms in that sector, has performed particularly well this year, rising by 61% year to date. The consumer goods and industrial indices have performed not so well, rising by 2% and 10% respectively. The banking index, on the other hand, has fallen by 5%. With earnings season well underway and fears that Nigeria may slide into a third recession in 6 years, Abdulaziz Bakari, research analyst with Chapel Hill Denham, joins me to unpack the movement on the Nigerian Stock Exchange. Abdulaziz, welcome to Business Edge.
Thank you.
So let's start with the performance we've seen so far. It seems to have been quite a good year, or quite an okay year for the NGX. What sectors do you think have particularly driven this performance?
Okay, thank you very much for having me. So far this year, in terms of the sectors that have driven the Nigerian equities market performance, is largely the telecommunications sector, the consumer sector, and also the oil and gas sector. Those are the major 3 drivers for the market rally so far this year.
So let's look at the oil and gas sector, which has seemingly outperformed all the other ones, all the other share indexes. It's up 60% year to date. To what extent do you think that this has really been driven by the higher oil prices we've seen internationally, or is there something else at play?
Okay, so I think a major driver to this is the oil price, as mentioned earlier. So far this year, you know what has been going on between Ukraine and Russia. That actually drove oil price higher significantly this year. Although just looking at it from point of view of June to August, where we are right now, you see that there's a bit of a moderation. But aside the rally in oil prices, just bringing it home, looking at what has been going on in the oil and gas sector in Nigeria, talking about Seplat, you know what transpired between Seplat and the acquisition of the ExxonMobil assets. So just looking at that alone has actually drove Seplat stock higher significantly this year. However, just recently, just due to the back and forth between the federal government and also Seplat, also in addition to NNPC as well, you'd see that probably the deal between Seplat and ExxonMobil asset might no longer go through. So due to this factor, there's been a bit of volatility on Seplat stock at the moment. Just looking at the market, you see that on the offer side, we've seen a lot of offer for Seplat. A lot of investors are trying to sell off this stock just due to that news. But just looking at the overall market so far this year, just the oil and gas sector so far this year, looking at it in terms of oil prices, right? We expect that oil prices will continue to trend on this bullish note. So just for us in-house in Chapel Hill, we expect at least on the average, you will see oil price around $90 to $95 per barrel for the rest of this year. And that's also positive for stocks in the oil and gas space.
Okay, so even though the Nigerian Stock Exchange is actually up year to date, what we've seen is that the all share index is down 2,628 points from even a month ago. So what do you think is driving this bearish sentiment in just about 30-something days? Okay,
thank you very much for that. So I would like to put into context here. So at first, you know, Nigerian equities market has rallied to just this year, as of May 27, 2022, it touched the highest high, that was around 26.61%. So since then, we've been seeing a slowdown. So the Nigerian equities market, we have a lot of local investors compared to historical years where we have more foreign participation. So this local participation is largely driven by the PFAs. And right now, you know, once we've seen market rally significantly so much this year, so a lot of investors are just trying to take profit from the market. So like I mentioned earlier, the likes of Seplat done significantly well this year, even consumer names as well. Despite the tough macroeconomic environment, we saw what happened so far this year. A lot of them started to increase price in order to hedge against the rising cost of raw materials. So we saw investors buy into those names. But right now, it seems it has been overstretched and most of the investors are just taking off their profit. Also, when you look at the fixed income side of things, interest rates have started to increase across the curve. Just even looking at it on the monetary policy side of things, we saw just this year alone 250 basis point interest rate hike. So investors are now they're now a lot more comfortable with, let's actually go on to the fixed income space where it's kind of more safe compared to the equities market. So that's actually another driver to this recent sell-off that we're seeing in the market.
All right. Abdulaziz, before I let you go, I have to ask this question since I have you here. One thing that could affect the markets is Nigeria's upcoming elections. And we've seen investors in the past, they've displayed a degree of sensitivity around Nigerian elections. We've seen many pull their money out of the burst due to fears of political crisis. Are you expecting to see this kind of movement this time around, or are things looking like they might be shaping up a bit differently?
Okay, thank you very much for that question. So far, looking at it so far, recent years, during this kind of period, during election time, at that time, we had more foreign portfolio investors in our country. But right now, when you look at things, it's really more driven by the local investors, largely the PFAs. So we would expect a bit of volatility, but compared to historical years, I would say no. Because it's largely driven by the local investors. So we won't really see a large sell-off. So for us in-house in Chapel Hill, we'll expect that this year, most likely we will see a 16% year-to-date return for 2022. So we don't expect that because of the election, we would see market sell off significantly.
All right, Abdulaziz Bakari, research analyst at Chapel Hill Denham. Thank you so much for joining me. We look forward to having you back.
Okay, thank you.
And of course, the Nigerian Stock Exchange, NGX, is one that many keep their eyes on across the continent. We also watch out for the Johannesburg Stock Exchange. We watch out for the Nairobi Stock Exchange. And on Stock Market Watch, we'll be making sure we touch base with the continent's leading exchanges to see how movements and things are shaping up. You're watching Business Edge. It's time to wrap things up, and I'll do that with NC4 to watch. And to a few stories we're watching very closely as we wrap things up on today's show. Egypt's Monetary Policy Committee has maintained the deposit rate at 11.25% and the lending rate at 12.25% for a second consecutive meeting. The country's economy is reeling from the spillover effects of Russia's invasion of Ukraine, which has seen inflation running at a 3-year high as food and fuel import bills soar. Uganda says it will buy emergency short-term power of 60 megawatts from Kenya to stabilize supply after last week's heavy rains led to a shutdown of its 183-megawatt Isimba plant. Reports indicate that the facility at the reservoir was submerged last week, short-circuiting switchboards and electric motors. Finance Minister Enoch Godongwana says the public and private sectors in South Africa need to significantly increase capital investment to bolster the country's economic growth and reduce unemployment and poverty. He was speaking during the Consulting Engineers of South Africa Infrastructure in Daba, noted that the capital investment by the private and public sectors amounted to just 13.7% of GDP in 2020. And finally, Mozambique is poised to ship its first cargo of liquefied natural gas overseas, joining the ranks of the world's exporters as a global energy crunch pushes prices of the fuel to record highs. The country is firing up its first export terminal as tight gas supplies after Russia's invasion of Ukraine sent prices soaring in Egypt, where countries including the UK and Germany have warned that the fuel squeeze could prompt rationing and trigger a recession. And that's how we wrap things up on today's episode of Business Edge. Thank you for joining us. Don't forget to follow me and follow the company on social media. We are at News Central TV. You can, of course, download our mobile app, subscribe to our YouTube channel, use every single way available to be part of the conversations we have here. At 12 p.m. West African time, you have News Central Now coming your way. I'll see you on Monday, 11 a.m. West African time. I'm Tolulope Adeleru-Balogun.